Good morning, everyone, and welcome to the Ankerstar Wealth Market Update. I'm your host, Allison Ankerstar, and today we'll be talking about how to prepare for recession, how to borrow against your portfolio, and why investing is so difficult. But before we begin, as a reminder, this financial education presentation should not be construed as personal financial advice. Full disclaimer information is available at ankerstarwealth.com. Good morning, Steve. Several major economists are forecasting a recession, and you're on record saying that we are likely in one already. What should people be doing right now to prepare for a recession?
Well, hey, everybody, and I think that's a great question, right? Whether we're in the recession or whether it's coming, one of the two. There's some things you need to do, and you guys are mostly doing it already. But certainly, these are things to think about if you haven't thought about them yet. So 74% of consumers, that's all of us put together, are concerned about a recession. But what can we do about it? So the 5 steps. First one is update your resume. This is something that people, if you're in retirement, okay, it doesn't apply to you. But if you're not, people always think they're invincible. Well, just realize that even though it's kind of a worker's market right now, if you will, i.e. the great resignation, people stepped away from jobs. So now employers are having to pay more and more to get help, let alone good help. That it's really, you don't have to worry about this too much. But if you fast forward 6 months into an actual recession, what do companies have to do in recessions? They have to lay people off. What are mortgage firms going to do when the housing market, which has already started to come in a little bit, shifts? They have to lay people off, right? So if people are getting laid off, you might get caught up in that. And, it is a little bit arrogant to say, nope, that'll never happen to me, right? So at least, think about it slightly as to how safe your job is. And if you do get laid off, even if it's an unlikely event, like tail risk, if it's an super unlikely event, but if it happens, are you able to get another job right away? Or would you be out for 6 months to a year while you got your stuff together? So that's why this is number one, is update your resume, just to make sure that you have a plan in place in case the unthinkable happens, really. Secondly, reducing expenses. You've heard me often say, we don't have a lot of control over what we make. Some people have more control than others if they're on a commission, but if you're in a traditional job where you're getting a salary, you don't really have the ability to grab a lever and move it, if you will, to make more money. You do, however, have the opportunity to reduce expenses, so spend less. So that's something to think about. It's like, hey, if this is going to get as bad as we think, and we're not talking the market, we're talking the economy. If this is going to get as bad as we think, let's just start dialing back on some things right now to make sure that we have some extra money in case it gets kind of ugly, and or one of the people that are employed get laid off. Bulking up your emergency fund. Excuse me. What really we talked about a couple of shows ago is about that cash flow versus net worth decisions. So if you have cash on hand, then to pay your bills and pay your taxes and, buy a new car, whatever it happens to be, then you can use that cash. If you don't have cash on hand, then you're either financing something that you may or may not want to finance. If you're getting a good deal, then take it. But if you're not, you might be forced into liquidating some of your portfolio, and now's not the time to do that, right? We don't know when it's going to recover, but we also know that now's not the time to be selling out of your portfolio. So, bulk up your emergency fund is more of the spend less. Let's put a little more money in the bank to be able to ride this out. Lastly, pay down debt. Fourthly, pay down debt. If you have anything that's above that 4% as far as interest rate, might want to start paying that off, because you're going to want that extra cash flow coming in to be able to cash flow things in a recession. And last one is probably the most important, as far as when you're hearing me talk, is staying invested. You really don't want to panic or get scared out of your long-term goals. So people say, well, I don't like the market. It's like, well, then you don't like your long-term goals, right? And they're like, well, now wait a second. It's like, I do like my long-term goals. And I'm like, well, then you kind of have to be patient and wait. And it sucks. I hear you. I empathize with you. The numbers look ugly, but they won't look ugly forever. This too shall pass. So those are the 5 steps. I thought it was a pretty good article there on CNBC, how to prepare for a recession.
Next, mortgage rates are close to 6%, with the interest rates rising significantly so far in 2022. Is there an option to borrow money against your portfolio to buy a house?
So yes, there is the answer to your question, Allison. Now, should you is a whole different other story. So I, Steve, am not telling you, listener, that you should go out and do this. even if you're not a client, I certainly don't know if you should do it or not. And if you are a client, we still need to talk before you go out and do something like this. But if you have a sizable portfolio, and I would, my comment would probably be $500,000. You can do it all the way down to, I think 100,000 is the minimum, but it has to be a taxable account. It cannot be from a retirement account. But if you have a sizable, again, I'm using the term $500,000 and above taxable account, then when you go to buy a house, you don't have to talk to mortgage people anymore. You can do it right from your own portfolio. Again, can, not should. So, that's another determination. But certainly what you're doing at that point. So if you have $1 million portfolio, you can basically borrow $500,000 at around 3%. That's going to creep up a little bit, but it's not creeping up like mortgage rates, right? So if you ever, and I know I was in this category, and I know some of you that are listening we're in this category where when I retired from the military, my income went from, over six figures. It wasn't huge, but it was, into the six figures to my retirement check, which is less than half of that. And then, even though I had what I would call significant assets in retirement accounts, taxable money, all of that stuff, I go to buy a house and I went to get a mortgage. They only use the income portion of that. And my point, so I kind of looked at the person and I was like, well, I could pay cash for the house. So why don't I get to count that money? And they're like, sir, if you can pay cash for the house, why are you talking to me? I was like, okay, well, I didn't like their tone, but they were right. So give credit where credit's due. I'm like, okay, I hear you. Don't like what you're saying at all, or the way you said it, but you're right. So at that point, I was either going to pay cash or find another way to get a mortgage. Fortunately, I did find another way to get a mortgage, but it can be challenging in those times. Now, had I really known about this, I could have used my own assets to be able to lever my way into the house and not have to worry about anything. So kind of an interesting thing I didn't know about at the time. Again, the interest that you normally pay on a mortgage, if you're at the level to where you can get a write-off for that, you do not get a write-off in this case. Okay. So that's the only thing you lose. But so few people fall into that standard deduction where your interest is more than the standard deduction, especially if you're married. So few people get the mortgage interest write-off anyway, that this is really a better way to go. And again, there's some risk with it. So we would have to talk about that.
Last, retail investors are always looking for crystal clear guidance on whether or not to buy stock. Professional investors know that there are always two sides to every story.
Well, the issue here is there are two sides to the story, and this is what I wanted to show everybody because I think it's kind of funny. And I'm not saying that if you read an article, if you read an article, you can buy the stock. Here's what I'm saying is, my phone will ring and it's just like, hey, Steve, I read this article on Tesla and it's saying that the shares could fall more than 40%. So I want to sell my Tesla stock. And I'm like, well, I kind of believe that Tesla's overvalued versus the stock price. So I'm like, sure, let's do it. Or the phone could have rang if at 8 minutes later, if you look at the timestamps on these, 31 minutes ago versus 39 minutes ago, you could have logged in 8 minutes later and clicked on the top story that said Deutsche Bank sees Tesla rallying back above 1100 on a sharp second quarter and said, Steve, I just read this article and I want to buy more Tesla stock. And then I would be like, well, I don't think that's a wise idea. And here's my thesis for why that is. My point being, there are always two articles out there. So if you are trying to get into the business, and I do it full time, if you want to get into educating yourself, not only do you have to find both articles, and they're out there for, I don't care how small the company is, there's going to be a pro article and a con article. Find them and read them. Which one's more important to you? That's correct. It's the one you disagree with. I learned this in one of my master's degrees, the final one, actually. It's like, stop reading the stuff that you already believe, because you don't need to read that anymore. Seek out the contrary argument and read that for what it is. Look for facts, look for things that challenge your assumptions, and make sure that your position is solid against all of these arguments. So if you're a fan of Tesla, instead of reading the article that says 1100, that it's on, you would actually want to read on why JP Morgan is saying that the shares could fall more than 40%. And after you read that article, if you're like, nope, I think they're wrong, then you're fine. But you should not simply read things that reinforce your own beliefs. And I don't want to go political, but I will say that like 99%, okay, let's just call it 100% of people that watch the news all the time watch the channel where they believe what everybody's saying. Okay, your Republicans watch Fox News, the Democrats watch CNN or MSNBC. All you're doing in that situation is you are, confirmation bias. You're seeking information that tells you that what you already know is correct. That is dangerous. Okay, certainly. I mean, if you want to do that in politics, you do you, right? But if you want to do that in the real world where there's actually capital at stake, you want to see both sides of the story. And then ultimately you have to make your own decision based on all the information that's out there. So I just want to bring that up for everybody. And that's why I think people get frustrated when they try to manage their own money, is they'll read an article and they'll buy something. Well, no, you don't get to buy it until you've found another article that says why you shouldn't buy it, and then synthesize both, and then go out and make your decision on that. And that ultimately is why I think investing is so difficult for most people.
Thank you, everyone, for your questions. Please submit your questions as a comment through social media or directly to our email at vipservices@ankerstarwealth.com. And don't forget to like and subscribe to get daily updates. That's what we have for today's show. I'm Allison Ankerstar, and we'll see you back here tomorrow.